energy and metals are more interrelated and interconnected than ever. How does the coal and the oil price sort of affect gold, silver, precious metals, base metals? We're talking to the pro now. We have Matthew Water coming on. Stick with us. It'll be definitely very, very interesting. Welcome back to SF Live. My name is Kai Hoffman. I'm the @JR Mining guy on Twitter. And somebody once told me you should never open a podcast episode with an apology. But if you're watching us on YouTube, apologies for the baseball hat, but there was no way I was taming my hair today. And I'm long overdue for a haircut. So please bear with us. Be polite in the comments. And yeah, it's not going to happen again. Maybe once or twice this week until I get an appointment. So apologies for that. But thanks for sticking around. Like, it's going to be an amazing episode that we have lined up for you. We have Matt Warder here. We met him in London last week. He's dubbed the King of Coal. And you'll find out in a second why. Actually, let me bring him on the screen. Matt, it's great to see you. Thanks for coming on. And it was so great meeting you.
Oh, you too. I had a great time in London, Kai, and I really appreciate the chance to come on the podcast. The more that I talk to folks, most of us analysts tend to sequester ourselves on the metal side or on the energy side, and really all of these markets are more connected than ever. Especially I think going through here over the next decade. So happy to do it. Happy to talk about all those interconnections.
Absolutely. I think I'm going to learn a lot today because I'm really weak knowledge-wise on the oil and gas, or in particular the coal side. So for me, this is going to be a very steep learning curve, our conversation. But before we kick off the conversation, Matt, why don't you run us a bit through your background, sort of establish a bit of a framework, and then we'll go from there.
Sure. I started my career, coming up on 20 years ago at international global consultancy Wood Mackenzie. I started off as a coal market analyst for the small geological firm that Wood Mac eventually bought. Basically worked my way up through the ranks. I started in Central Appalachia, which produced, at the time, a pretty fair amount of the world's metallurgical coal, which goes to make steel, and a fair amount of high calorific value, very high heat, very low sulfur thermal coal that went to both domestic and export markets. Over the years, it became pretty obvious that coal consumption globally was on the decline, most especially on the thermal side. And Wood Mackenzie had acquired a metals consultancy called Brooke Hunt, which covered mainly base metals, a little bit of precious. And it occurred to them with all of this met coal expertise that if we added a steel vertical and an iron ore vertical, all of a sudden we can cover the industrial. So I raised my hand and volunteered to build up all the asset coverage in the Americas for iron ore and steel. And so I kind of vertically integrated myself up the supply chain, as it were. And then became a generalist investor, or not investor, generalist researcher. Over the next few years, and got an opportunity to work closely with Sprott and Rick Rule, who basically trained me up on base metals and precious metals. And so now here at this point in time in my career, I'm this kind of energy, metals, and mining. I have a lot of broad knowledge across the sectors, but from a deep dive perspective, very well versed on coal, and slightly less so on iron ore and steel, but still pretty deep.
Yeah, fantastic. Yeah, we had a really interesting discussion before we hit the record button as well. So really, I can't wait till we get to that point in our discussion here on the podcast about how the metals and the energy side are sort of interconnected, and more than ever, you mentioned. So really looking forward to that because you seem to have the expertise on both sides. But we met in London, so why don't we start there? LME Week was about 10 days ago. What brought you to London? Why were you there? And what were some of the key takeaways for you?
Primarily, I cover all commodities. So having an understanding of how all the primary research houses and the banks are approaching the metal sector is critical to try to create a worldview. Possibly more importantly from that, over the past year or so, I've gotten to know this really fantastic community of mining experts and commodity experts on Twitter. And this was basically the central junction point of all time and space for that crowd. And a lot of us hadn't gotten a chance to meet in person, yourself included. And so, to me, I just viewed this as an opportunity, not only to go over to London and get, top-down views from the major researchers, but also, to connect with folks like yourself so that we can, sort of better communicate the message of how, just how on a knife's edge supply is, really for across all commodities here over the next decade.
One of the takeaways, like in the conversations or in the sessions, I know LME on Friday. I didn't attend, but it was more of an indoctrination, I think, because it was about how the LME sort of works. But what
Right.
was some of the takeaways? Like, what did the research houses like? Was there a common denominator for all, or like divergent views on certain things?
Yeah, I think there was. So, by and large, I would characterize the very, very near-term view of most research houses as slightly bearish on copper, bearish on nickel. There's a little bit of supply that is supposed to come on, over the next, call it 6 to 12 months, that will put the market into a slight surplus, uh, supposedly. That said, the longer-term view, I think, over the past couple of years, especially, has become a bit muddier, so to speak. I think it's come to everyone's attention that ultimately consumers are the ones that are going to make most of these decisions at the purchase point, right? So they're going to buy either an ICE vehicle or an electric vehicle, or they're going to buy a less expensive lithium iron phosphate vehicle, or a more expensive nickel manganese cobalt powered vehicle. And a lot of these sort of specific choices that people make are uncertain as we go off into the future. Government policy is dictating the transition from the top down, but they're not making sort of the individual one-on-one choices that would make it more certain for folks. So I think all we can say is the desire for governments is to transition away from fossil fuels and more toward a metals-based energy economy, and the amount of financing that has been put in place to service that transition is woefully inadequate.
Oh, good point. Good point. We need to talk about that. Maybe we'll table that discussion for just another 5 minutes before we get to that. But access
Sure.
to capital in mining is a very difficult problem. Um, I'm trying to figure out like where we go. You mentioned a couple things I want to follow up on. One, copper and nickel are expected to be weaker,
Mhm.
or forecasted to be weaker. Why don't we start there? Because I find that interesting. Because everybody talks about the EV revolution, and everybody says, "Well, copper is going to be in short supply." What was the main
Yeah.
reason for them to say, "Okay, copper demand is going to be weaker"? Just the recession?
Uh, no, I think there were a couple of mines that were returning to production. Uh, a couple of projects that were coming on. Nickel, I mean, nickel was the big story, was the Tsingshan assets in Indonesia that are going to spit out a whole lot of nickel pig iron, and the market for nickel is still very stainless steel driven over the next 2 years at least. Anyway, it's not going to be until mid-decade or so that when battery demand for nickel really ramps up. So those were really the two primary factors. And again, like I should point out that although these researchers were projecting a surplus, there is still some uncertainty as to how well supply is going to perform. If supply underperforms in the next 6 to 12 months, then that surplus doesn't materialize necessarily. So it's there's a lot yet to be determined, and I think it's incumbent upon analysts like ourselves to be increasingly Bayesian as time goes on. When we get better information on, China's reopening, or sort of individual mine performance, we're going to have to update quickly and be nimble. I think more nimble with our short-term views.
Short-term views, perfect. It was the word I was going to use next to start the next question. Because we've been flip-flopping a bit through the discussion. I want to stay on energy for before we talk metals. Flip-flopping is great because short-term views on energy policies. The governments, everybody's been saying, well, we need to go renewable. We're pushing like wind energy, solar. But now governments, specifically in Europe, are flip-flopping, meaning we're ramping up coal power production again. We're using nuclear again.
Yeah,
We're trying to burn a little natural gas because we don't have as much access, but especially coal. We need to talk about.
right.
Like I've just been trying to look up some number for hard coal and lignite energy production in Germany, and it looks like I don't have the exact number because it's just a chart, and I'm trying to read off of it. It looks like 35% of our energy still comes from coal. Right. So, what is the coal discussion like, and what do you see in the market?
Well, there isn't really much of a coal discussion other than people need baseload power now because the supply of gas is, I don't want to say unreliable, but we aren't exactly certain how much is going to be available in storage at any one point in time. And so the way that our grid is set up is we have two basic classes of power generation. We have on one hand baseload generation, and on the other hand we have intermittent generation. And in general, when the intermittent, and these are renewables, wind and solar primarily, when the intermittent sources are dispatching, you have to defer to them. You have to pull all of that power into the market, and then you have to adjust the base load behind it in order to keep the grid, at a constant charge. Now, naturally, when wind dies off, during the day and solar begins to ramp up, and vice versa at night, you need to be able to ramp up baseload generation to fill those gaps anyway. In the past, we used peaker plants to do that were primarily natural gas. We did the same thing for periods where demand exceeded what we expected it to be. We could draw more on natural gas, satisfy that demand, sort of go from there. But in recent years, the preference for governments has been to rely increasingly on natural gas. And in the case of Germany in particular, that meant relying on Russian supply coming from Nord Stream 1, Nord Stream 2, and from the southern pipelines as well. Now, obviously, over the past year, that's become an issue. So now we're faced with the challenge of supplying these European plants without Russian gas or without reliable Russian gas. And the truth is, although supply chains can adjust, you do have to make the investment in both the new operations and the pipelines and the LNG export facilities and the LNG import facilities on the other end. So it's not something that is particularly elastic from a supply response standpoint. And if you don't have enough gas, then you have to move down the other types of baseload generation, which are coal and nuclear and diesel. If your nuclear plants are running full bore, then you need more coal. And coal over the years has had this very sort of top down demand destruction that's come from the government level, and supply has behaved accordingly. So we have mines that have shut down here in the United States that are largely never to return. And so when the world all of a sudden asks for more coal, the U.S. has historically been the swing supplier to the world. Well, we can't ramp up. And in addition to that, we have a labor shortage, not just at the mines, but we also have a labor shortage at the railroad. So the ability to even produce the coal is limited. Then the ability to get the coal to the port is limited. So that means either we need more coal from Australia or from South Africa. And truth be told, those countries are going through very similar supply dynamics. So it's a complicated picture that honestly we need to think about from the top level policy and adjust over the medium term in order to address.
Interesting. As I said, I don't know much about the coal space. That's why for me this is a huge learning experience as well. You mentioned supply like constraints, but it doesn't sound like there's a deficit. It's more of a bottleneck getting the coal, like the supply, to the end user. What has that done to the coal price? And do you see a debottlenecking happening anytime soon?
Well, without Russia, there is sort of a supply deficit, and it's maybe deficit's not the right word. It takes times for supply chains to adjust, right? So Russian coal typically came into Europe. They provided about somewhere between 50 to 70% of Europe's coal imports, and the rest went to a smattering of Northeast Asian, Southeast Asian countries. A fair amount went to India. Now Europe's taking ostensibly no Russian coal. They bought as much as they could, before the sanctions went on, and now they're stuck with trying to find coal from other regions of the planet. Meanwhile, Russians, I just hit my desk there. Russian supply is adjusted. It's going more into India, into China, into places that have a let's say better working relationship with regard to those sanctions. They either don't care about them, or the U.S. understands India's and Russia's sort of complex relationship. But the type of coal that went into Europe in particular was very high calorific value thermal coal, and about 50 million tons worth. And the problem with that particular grade is that there isn't 50 million tons in the rest of the world to step in and replace it. Not this year, not next year, ostensibly not ever. I mean, it's connected to either operations that can't ramp up in the United States and won't, or unlikely project ramp ups in Australia. It's just you can't replace the quality of coal necessary to supply those plants with the base load of supply that we have, basically.
What do your forecasts say? How much longer do you think we're going to be in that supply demand sort of deficit situation based on energy policies that you're seeing being thrown around in the world right now, especially in Europe? How much longer do you see that play out?
Currently, I think it plays out until the gas issue is solved, right? Until there is a solution for Russian gas, I think Europe is going to have this problem ongoing every year, and I think over the medium term, that kind of puts a bid under LNG prices, which in turn puts a bid under coal prices. So I think that whole complex of gas and coal and power is going to be comparatively highly priced over a few cycles. And I know there's talk about how Europe actually did a great job stockpiling gas and coal in advance of the winter. The question is now that energy prices have come back down, the TTF has come back down because you don't need to buy as much. It's November now, and temperatures are actually pretty warm. But our industrial company is going to restart in Germany, which are really integral to the German economy. I venture to say they probably will. And if they restart too fast, then all of a sudden you're going to have a bigger draw on gas, I think, than most forecasts expect. I don't think the problem is solved by filling up storage tanks to the top. I think the problem is solved by actually correcting and improving the ability to get gas into the region and out of other regions, I guess.
Really informative. You mentioned big companies, energy prices are an issue as well, not just access to energy. But I want to talk about, like, we interviewed Doomberg here on the channel before as well. He's a great Twitter follow, great newsletter. And we were talking about gas reserves, and Germany's sitting right around 98%, I believe, right now. Can you explain to us again what that really means? And is that enough to get us through the winter? How much do we need? And how much do we need to find from elsewhere? And not just Germany, by the way. Sorry. Like, I keep coming back to Germany because I'm sitting here in Frankfurt. So apologies for that.
No, that's sure. I mean, Germany has, compared to a lot of other areas in Europe, a fair amount of storage. So I think for Germany, it means Germany's probably going to be okay. The question is what happens to these, to these other areas of Europe that don't have as robust a gas storage as Germany does. Can the product that Germany has actually be shipped and mark those shipments to market? I don't know the answer to that. And then the other factor, of course, is weather. And I'm certainly not a weatherman. My track record of predicting the weather is unblemished by success, as Rick Rule would say. So there are a lot of factors that go into actually trying to prognosticate that. I expect hydrocarbons to be tight. I'll just say that and kind of leave it at that for the time being. As soon as the bid comes back into the market, energy prices go back up from where they were.
So as an investor now, looking at this space, let's talk about how you would play. Like, don't give financial advice. We're just here for financial education. But how would you play the sector right now, or how are you playing it? And what makes sense? Are you buying coal stocks, for example? And like some of the more delicate instruments are maybe a little far-fetched, but any stocks and I want to get stock names, but how are you playing the sector? Let's generalize the question.
Well, I mean, I'm most comfortable talking about coal. I do have some equities that are exposed to European energy prices. I have less of them now because we knew the price was going to peak in summertime. We knew storage was going to get reasonably well filled, and now we're waiting for that inflection for weather to get worse, and we can size those back up. But mostly, I'm playing it through coal because coal is literally the one commodity that is absolutely supply constrained, and I'm concentrating my exposure primarily in high calorific value, high heat coal suppliers. So for me, that means in the United States, Consol Energy, ticker CEIX, a little bit of Arch Coal, ticker ARCH, and then in Australia, my two primary holdings are Whitehaven Coal, ticker WHC.AX, and New Hope, which is NHC, I believe, .AX as well. So that's on the thermal side. On the metallurgical coal side, metallurgical coal has a different sort of restocking cycle than thermal coal does. Usually, steel producers come in to restock kind of in the late fall and like early winter, and then again in the early spring to like middle spring. So we have these periods in November, December, where people are coming into the market to make sure they're stocked up for next year. And then also sort of in March and April, especially the Chinese, after the Chinese New Year celebration is done, typically they come back into the market, get some quarterly contracts done to make sure they're well supplied. And right now, so metallurgical coal prices are fairly resilient. There's also one segment of metallurgical coal that can cross over into the thermal market. That's typically coming from the U.S. That's a high volatile A coal, we call it, that can cross markets. That's primarily produced by a company called Alpha Metallurgical Resources, which just reported today. Pretty good earnings. And then also I should mention another sort of diversified producer, Peabody Energy, ticker BTU, which is probably the one I think that's poised over the course of like 23 and 24 to have the sort of outsized returns that a lot of their peers have had over the course of the past 2 years.
BTU, because you've been tweeting about it actually today. I think I looked up the chart, and they've already doubled for the year. They're up 150%, I think, already. So
yeah, I think there's at least another, call it 40 to 50% upside without prices doing that much. Prices could even decline from there. The interesting thing about Peabody is that they have a covenant in one of their on one of their bonds that prevents them from initiating a shareholder return program until they either negotiate with the bondholders or alternately just pay off their debt entirely, which is certainly a possibility here over the next, call it 6 months. So once that happens, then they have this big cash position saved up that when it gets released to shareholders, I think will look like a pig going through a python, provided that they don't make any big acquisitions or plans to grow production and those are the types of things that we were talking about last week.
Yeah, absolutely. I've been chatting with one of the friends we met together in London just ahead of our conversation here. He's like, "Hey, you got any questions for Matt that I can ask him?" He just sent me one while you were chatting, and it fits before I move on with the conversation. Just sort of wrap up on coal. He's like, "Can you own coal with a clean and green conscience?"
I mean, I can. I mean, I'm probably the only like very liberal guy who talks about this market pretty openly. A lot. And the fact is, for me, I've been around the industry for a long time. I have a lot of friends in the industry, and for me, it's I agree largely with the notion that we've spent 100 years creating energy by burning stuff. Wouldn't it be better to do something else for a while? I tend to agree with that sentiment. But that said, you have to have a plan to get from here to there, and that plan isn't going to be a 10-year plan or a 20-year plan. This is going to happen over the course of a generation, I think. And so the most difficult thing for governments to do is to succession plan from one administration to the other, especially during these really polarized times where you just have this vacillation back and forth from conservative to liberal and so forth. And so I think it's incumbent upon analysts and folks from the industry to sort of articulate that, look, we know we can't get there directly from here. So instead of that, why don't we take a reasonably, well-paced decarbonization plan for the next 4 to 5 years? And as the technology becomes available, as we finance these mines, as we understand how much more material we need, then we can accelerate that, I think, as we get into the early to mid 2030s and the 2040s. But of course, that's not happening because that's winning elections and those sorts of things. But I do think the project management of the energy transition, the pace of decarbonization, is probably, to our sector, the most important issue to get a handle on as an analyst, as an investor, as everything. And it changes. It has changed so much in just the last 2 years.
Absolutely, yeah. Your answer actually just opened the door to the question I wanted to get to next. So, without making a hard cut or anything, it is talking about like planning for the next steps and sort of it comes with investing, like as well. You need to invest a lot of money, and we had that conversation before we hit record. Is like it comes down to investing, sovereign debt, sovereign debt, and also it comes back to some money principles as well. Right, Inflation Reduction Act, $400 billion, I think, in subsidies. Some of the companies are being flooded with cash. Like, what are your thoughts on that, and like, how is that connected there?
Okay, this is a pretty big topic. I mean, the way that I think this is going to go is that to have an energy transition that is at all accelerated is going to require help from governments. It's going to require subsidies. It's going to require a lot of debt, and that's debt that our kids are going to have to pay for. So the faster we go, the more debt that we incur at what are comparatively elevated levels relative to future inflation, right? And so that's really the concern. Is like if we go too fast, are we going to incur so much sovereign debt that we're that we're in turn going to have a crisis as to how to unload that. And for me, I think that from an investment perspective, if I take a top level sort of top down view of that, that means that kind of going forward, we have to be. I think you have to be invested in some form of hydrocarbons. I'm comfortable with coal and a little bit of oil and gas, at the very least on a seasonal basis, to refined products mostly as well. When we head down into like the plastics, petrochemicals, I'm less enamored with those industries for at least probably 6 months, just from a cyclical perspective. And then we have to be targetedly invested in the metals that we know are going to participate the most. I think that means copper. We can't electrify anything without copper. So we have to take advantage of these periods where we may have a surplus, and then begin to build up positions on, not just established, names like Freeport-McMoRan, et cetera, but also I think you have to pay a lot of attention to Robert Friedland's projects. Both Ivanhoe Mines and Ivanhoe Electric are pretty interesting to me. And then the exploration companies who are going out and finding these new deposits, because we have to do more than that. I mean, one of my largest holdings has been Philo Mining over the past year. I mean, by now that the drill bit can tell all of the story that it needs to tell for that. But that's so I like copper over the longer term. I like nickel. Eventually, I want to get past kind of absorbing the supply from Tsingshan before before I go big on it. I think we do see a return of demand for integrated circuits, semiconductors, those kinds of things that has iterative impacts on tin later on in the cycle. I think 24. So I'm largely taking the basket approach with regard to the materials themselves, and then for the knock-on effects, I think we need to have precious metals positions. I think we need to be invested in gold, and if you're more of the torquey mindset, than silver for sure. Because if we're not exploring for enough metals and hydrocarbons to manage the transition, then all of this it's all going to show up eventually in sovereign debt, and we're not exploring for enough gold and silver either from that perspective. So to me, these are all interconnected. Some precious metals probably second or third order effect from the energy side, but they're natural resources that I think are going to have a really impressive decade, and I think it puts folks like us in good positions to talk about these issues, both from the policy level down, and then from the fundamentals up.
Yeah, fundamentals up. Just China and Canada sort of seem to be having a dispute over lithium projects, because Canada told a few companies, companies, sort of investors, to divest of their holdings in certain companies. And China said, well, there's going to be retaliation, right? So I put out a tweet yesterday. I think resource nationalism is going to be one of the themes for the remainder of the decade. How does that factor into your forecasting and your prognosis as well?
Oh, well, again, now we're getting into the geopolitical side, and again, my track record isn't particularly good. I'm not a very good geopolitical analyst because let's face it, people don't always behave rationally, and governments as a collection of people certainly don't always behave rationally either. If you have a lot of bad advice and your leaders take that bad advice and codify it and cement it into policy, then bad things are going to happen. I mean, China. Let's take the EV market in China. China's basically forcing EV adoption, here over the next few years, and they have some of the resources to be able to pull that off. But what happens 10 years down the road after a centrally planned economy has done that, and that investment happens to turn out to be wrong. How are they going to do? Are they going to be able to backtrack fast enough to get enough hydrocarbon related vehicles produced? How are they going to react to that? I think there are too many questions that don't have answers to make a real definitive forecast as to how any of this plays out specifically. I think you can just sort of broadly say that, well, we have a molecule shortage, that is primarily supply driven. It's not necessarily demand driven yet. And until then, it's much better to be, I think, in the extractive industries than in other interest rate sensitive sectors like that.
Yeah, no, very good point. Interest incentives, because gold seems to be interested in interest rate sensitive as well, quite a bit actually. Silver less so, more of a tech metal, battery metal. I think that's more of a metal, also closer to the energy transition as well. Um, Matt, I know you cover a wide range of commodities as well. You're an expert, obviously, on the energy products, oil, gas, coal. Any metal or any element that we haven't talked about, sort of that is being forgotten? You hinted at tin earlier. Is there any other like metal like tin? I'm thinking scandium or anything else we should be paying attention to.
I mean, for me, not so much. I mean, I'm primarily, an energy, metals, mining, and industrials analyst, so that's primarily where my focus is. There's enough. I mean, goodness, there's enough to cover in just in the base metal side to span an entire career. I will say that most of the analysts that I saw in London tended to be very reasonably bullish zinc, I think, for the next 6 to 12 months. Which looks like from a supply perspective may hold some merit. I've rarely invested in any zinc producer other than Teck, so my palette is relatively limited there. But certainly for those in your audience who are familiar with exploration companies that are related to it, they'll have a better palette of ways to express that trade than I.
No, fantastic. I was just trying to get a sense of like, 'cause there's always that one element that you never hear about, and all of a sudden it explodes price wise, and it costs $30,000 a ton, right?
Yeah,
So,
I think the thesis behind that is that galvanized lines were a little bit behind due to kind of restrictions in steel production due to energy prices, and as producers play catch up a little bit, that's actually going to drive demand here in the near term, which I think stands to reason. I'm not particularly bullish steel in the steel space at the moment. Post, call it March, April, May. I really question the ability of China to both reopen and to really fund this next round of investment. I think 2023 is going to be a tough year for steel. In the U.S., we're a little bit insulated because we have these 25% tariffs, right? But as the steel industry goes, by and large, so goes zinc. But there's much like semiconductors, in 2021, there's when you have to catch up, then demand for the raw materials goes up, and I think there's some merit to that argument.
absolutely. No, fantastic. Matt, any closing words, anything we should pay attention to? I was going to ask you about price targets, but it's kind of tough with price targets in oil, gas, and natural gas, and thermal coal, met coal, right? So,
Yeah.
have to put you on the spot there, Matt.
No. I mean, I think if I had any closing remarks, they'd be broad ones. When I tend to go to metals conferences, for instance, and we see these kind of aggressive projections of how many EVs we're going to produce. Well, if you actually stacked up the auto producers' forecasts of EV production, and then you back calculated the copper intensity, the nickel intensity, lithium intensity, et cetera, we only have enough material to produce about 40% of vehicles going out through 2030. So those demand projections may be a bit aggressive at this time if we take all those automakers at their word, right? But really, I think the pullback is that with these big demand projections, you have to wonder where the energy is going to come from, where the diesel is going to come from if we're simultaneously not going to invest in hydrocarbons, right? And that, to me, has been kind of a miss with some of those, with some of the forecasts. And then conversely, when I go to energy conferences and we see these, kind of massive build outs of, renewables and solar over, 10, 20, 30 years, I look at that and I go, well, where is the copper coming from? Where are the metals coming from? So I really think it's important for both of those disciplines, for energy, for the energy sector and for the metal sector, to be more communicative, amongst analysts and investors going forward than at any other point in time in my career. Like the more knowledge that we share, the more awareness we all have of how changes in downstream demand are funneling back through to the upstream supply chain. I think the better we'll be able to communicate to, hopefully, to governments on what the most effective policy is going to be going forward. And I think that puts us in a really interesting position to to really influence thought on the matter. So that's kind of where I sit, and I just something I'm hopeful we can be positive contributors to in the future.
Fantastic. Now, let me close on an anecdote. Maybe you have a comment for that, because I had an interesting phone call with a German government official in Vancouver yesterday, or last week, sorry. And
Mhm.
he had a fire lit under his butt to find resource projects. And I'm not kidding. Like, he's the general consul in Vancouver. Okay.
Mhm.
So fairly high up, one below the ambassador in Canada. But like, he's aggressively looking for projects to introduce to his, like, I wouldn't even say investors, but to the government, and asking, Kai, what can we do to make this happen so we can secure resources? This is the first time I actually took any of this serious. I've been looking at lithium projects since, like Zinc, I've been always following through a common friend, and been looking at some certain things. But now the fire has been lit, because now, as you said earlier in the conversation, it's top down. It's being
Yeah.
shoved down. And now the government woke up 6 months ago, it feels like, and
Hmm.
is pushing that down. Like, maybe if you have one last comment on that, I find that really, really interesting, because I haven't heard that before.
Yeah, I mean, we're basically trying to figure out how to change minds at the policy level. I think one thing that can happen, for instance, is to find the right sort of corporate relationships that cross technologies, right? If we think about, one of my verticals is steel. There are a lot of steel plants that are, tearing down blast furnaces and building electric arc furnaces, and that's great for direct carbon reductions because you're not using coke. You're not as reliant on direct carbon reduction as a result. But when you fire up that electric arc furnace and you're in a place, say like Pittsburgh, well, the power grid that you hook it up to is primarily a coal-fired power grid, and so it's great for direct reductions, but it's not great necessarily for indirect reductions because that's going to draw a lot more power. I think there are opportunities to pair, small modular nuclear reactors. We haven't really talked about uranium or the nuclear industry, which I think is really an interesting bridge fuel. To kind of get enough base load to, if we're going to ramp down coal, maybe ramp up nuclear, or maybe pair some of these small modular reactor projects with an industrial project, and then try to find the right politician or the right person in a position of influence within government to hold it up, particularly to my liberal side of the aisle, as an example of, like, look what we can do. Look what we can do if we get the right people talking to one another, who can come together and create a project that's going to benefit the community, that's going to lower carbon emissions, that's going to send demand into a commodity, uranium, which we can go get a little bit more supply of. We may have to adjust enrichment facilities. We may have to eliminate some red tape, but this is something that we can do right here, right now. And I think, personally, I think those kinds of ideas and those kinds of messages, when you go out to voters, I think things like that are going to resonate because you're going to be showing up with solutions as opposed to rhetoric. And that's the kind of stuff that matters to me. I think that matters to people, and I think it's a much better story to tell. There's jobs at the bottom line. You're not taking away jobs, you're adding jobs. Like this, these are the kinds of stories I think we need to encourage to happen, be that through corporate development, or lobbying, or direct relations with government, or just through conversations like these, where we're evangelizing. I think participation in an industry that's going to be, if not the most important, one of the most important of the coming decade, and of the energy transition in general. So that's kind of what I think when those kinds of questions are asked.
No, I fully agree with you, Matt. We're on the same side there of the medallion. Fantastic. Matt, where can we find more of you? Fantastic conversation. Like, to you on hold for a second. Where can we find more?
Well, I'm really active on Twitter. I'm at MF Warder. That's Matthew F is in Finley, which is my middle name. MF Warder on Twitter. Um, my company, Seawolf Research, like, I have too much work right now, and if I had a website, I'd have way more than I could probably handle. But the Seawolf Research also goes to my calendar. If people want to set up a time to talk, then we can do that. But Twitter's usually the best place to get a hold of me,
Fantastic.
and we can go from there.
Awesome. No, I highly encourage everybody to reach out to Matt. Like, I really enjoyed our conversations last week in London as well. Really appreciate your time today. Amazing
Uh,
conversation.
appreciated chatting with you too, and appreciated that Indian food we got to eat the
Oh,
other
it
day
was
in London. That was
fantastic.
great.
Yeah, we found that by accident. Like you've been there before, but we stumbled across one of them. Oh, phenomenal. That dal, don't get me started.
Red, ready to do it again anytime, buddy.
Anytime. Just let me know when you come out of this neck of the woods again. So we'll do that.
Absolutely
And
will do.
everybody else, thank you so much for tuning in. We hope you enjoyed the conversation. I think I learned a lot. I just don't think I know I learned a lot. So let us know what you think. Leave a comment below. Don't comment just on the base cap here. I do apologize for that again, but I'm not going to lift my hat and show you why I'm wearing it. And but follow us on YouTube, follow us on Twitter, hit that like and subscribe button, and to share the video with your friends. I think it was super informative, and I think more people should know about it, what is happening on the other side of the coin, and what we're up to here. Thank you so much, and we'll be back with lots more content soon.